Restoring price stability will take some time and requires using our tools forcefully. Reducing inflation is likely to require a sustained period of below-trend growth. Restoring price stability will likely require maintaining a restrictive policy stance for some time.
It's a message that he wants to give. We're going to fight inflation, and we're going to keep at it, even if the economy slows.
He did make the point that, yes, there will be short-term pain, but if you don't bring inflation down durably, then there's going to be much more longer-term pain.
Dow is down about 1,000 points. The S&P has now broken the early August low.
Hello and welcome to Bazaar Morning Call. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, good morning.
Hi, morning.
I mean, it's deep, dark red across the board, wherever you look. And I think absolutely no doubt which way the opening is going to be. The only question is what happens after the opening. The ASX is right now indicating a near 400 point gap down. Is it possible that that gap, it's not as large, but even if it is, say, a 200, 250, which I think it's easily possible by 9:15, what after that? Does this move open up far greater downsides, or will dips get bought? I think we are at a bit of an inflection point in that sense, and we'll talk more about this over the next 2.5 hours. Markets very much the focus all day today here. Guys, hi.
Hi, morning Prashant, morning Nigel. And after yesterday's stunning victory that India had versus Pakistan, someone messaged me that, I hope this victory rubs off on the markets. But I guess life doesn't work that way, right? It's not that simple. And there's a range of emotions that we wake up to. Of course, that great day last evening. And
absolutely.
Everyone loves a good win, but I doubt that the Bulls are going to get a good win today. It was a global bear onslaught on Friday. No two ways about that. And Asia is sharply in the red as well. The Dow was down 1,000 points, as we said, the S&P 500. And this is the second week running that the global markets are under pressure. What did Jerome Powell say that spooked the market so much? All he said is that the central bank will not back off in its fight against inflation, so they'll do whatever it takes. The expectation is that there will be another big rate hike by the Fed in September. Some are even looking at 75 basis points. We don't know if that will come through or not, but he was more hawkish than was expected earlier, and that spooked the markets. The Sensex and the Nifty, of course, they in any case snapped their 5-week winning streak last week. FI sold a bit, about 51 odd crores. But I think the big question really now is, will global cues assume center stage? They will today. But in the run-up to the Fed event, more rate hikes spooking, assets like equities.
Oh, absolutely. We were talking about this on Friday, that when you have a central bank, amidst other central bankers, right, the basic big thing is going to be credibility, right? You want to sound credible amongst peers. I think that's the natural inclination. And I think it was about 7-8 minute speech. And that's all that he did. He said, we will not back off. I think that is basic. That got the market spooked in that sense. It's not as if the market was expecting a pivot. Some were saying, well, making fun of the whole situation that, well, they got a pivot, but not the pivot that markets were expecting. I don't think there was any pivot. It's just that he hammered in the point that the ultimate target is 2%. The inflation target is 2%. And that policy will need to be restrictive for some time to come, right? Markets are expecting rate cuts next year, 2023. You heard the Fed chair, and it doesn't look like that way. Of course, he said he also made the caveat that we'll be data dependent, etc. This is an interesting quote. We'll keep at it until we are confident the job is done, and they're ready to accept that hikes will cause some pain to the economy and households as well. Again, one more quote which stood out for me. The historical records cautions strongly against prematuring, loosening policy. You don't want to flip-flop. You don't want to cut now or pause now because you think, well, you got 1 month of data. And actually, he specifically said, we perhaps have got 1 month of slower inflation, but that doesn't cut it. We need more than a few. No prematuring, loosening, or taking the foot off the pedal. And I think this was one of those things. He also mentioned Paul Volcker multiple times, several times. And of course, Mr. Volcker is the inflation-fighting legend. Of course, the economy crashed by the end of it, but he said, we don't want that kind of a situation. But he said, make no mistake that this Fed is as committed as the Volcker Fed to bring inflation lower. So I think it was absolutely clearly textbook standard hawkish. Nothing out of the ordinary, I should add. It was not as if he said something which is not said before, but he made the point and kind of, set the line down. Where does this leave us? A gap down? I mean, US markets, of course, sold off very, very aggressively. And I think we get a lower start here as well. So on the Nifty, just a couple of things. And this is something which was a bit of a head scratcher on Friday as well. The futures premium was 100 points on spot. It's the highest it has been in a year. What does the futures premium indicate? It indicates optimism, right? So first of all, there is that 100-point extra, which I think will go. So that's why maybe the cut is seeming a little larger than it would have as well. The Nifty, and this is a point that we made on the editor's roundtable with that graphic, has remained inside the upper trend line drawn from the October highs. It's under it. And then, of course, I mean, when we put that out, the Fed chair was yet to speak, but I think we go lower in that channel on the lower bound. The Nifty 20-day moving average stands at 17,531. If you want a level to latch on to, which is very near term, I mean, you know, you could look at this, but this, of course, goes straight away. The bigger important kind of level is 16,951, which is nothing but the high made on the 28th of July. There was a bit of a gap there. The market bottomed in June, made a move up, and started furiously moving up starting the 28th of July. So there was a gap which is 16,951. So it's possible eventually, I mean, people who track technicals levels are focused on that level. Just a quick look at the what indices have done. So the second particular column is what the market has done from the recent highs. The S&P is down 6% after gaining 17% from the lows. The MSCI World is down 2.5% after gaining 14%. The Nifty is down 2% after gaining 18.5%. The Nifty, by the way, has beaten emerging market indices for 10 quarters in a row. So we are sitting on some pretty steep outperformance. So there is little room for error. There was little room for error. The market, as the futures premium was indicating, was getting a little ahead of itself. And I think it's going to get yanked back, straight back. The question is, after the gap down today, you know, does it open up greater downsides? It's possible we see 17,000 pretty quickly. But what after that? I think those are questions which we will tackle as we go along. Nigel.
Well, you know, let's take stock first of the FI flows. You know, people were worried that we had an FI net sell number on Friday, but you need to strip off that, you know, Rolex rings large trade. So stripped of that, in fact, they were buyers. The problem is that even stripped of that, the buy quantum has come down substantially. You know, in the previous week, you're getting 1,000, 1,500, 2,000 crores odd. So they're still net buyers, but the quantum has come down. What are the FIs doing in the FNO market? They covered some shorts, though they continue to remain net short on the index. So the short positioning is at around 61%. That compares with around 65% odd. There's high activity both on the call as well as on the put side. Just a quick point here. If the FIs are not going to be putting in the big money and they're going to be net short on the index, being net short on the index is not such a bad thing. That gives you hope of a bit of a short covering bounce. That's the way I look at it, at least. On the index option side, the 17,700 call has a huge amount of open interest. It is very active as well. So the bears, they are clear that the 17,800, 18,000, that's their zone. Bear zone is what you're looking at. And the markets will require a big trigger to get past that level. Now, the Nifty has corrected close to 450 points in the last few trading sessions. Today, to kickstart trade, you're going to be starting below the 20 DMA. Now, you know, the 20 DMA will be broke decisively. The recent low is at around 17,350 and the 200 DMA is coming in closer to around the 17,000 odd mark. SGX Nifty is suggesting that we're going to be starting bang in the slot. You know, so let's see whether or not, you know, if we get a start closer to around the 17,250 to around 17,300, that is going to be a very, very crucial zone. How do you approach trade? First hour low, track that very closely. If you're an adventurous trader and you can't, and you want to trade today, well, maybe that 17,250, 17,300, if you get that, risk reward could favor you. Crucial support zone at the 200 DMA at around the 17,000 odd mark. If you don't want to trade, just have a good, Monday and you have a truncated week ahead. But if you want to, I'm telling you, the first star low, that 17,250, you get it. That could be in the slot for the bulls. So.
Okay, the most important cue, right? The truncated week. And it's a big week. I mean, it's salary week, it's truncated week. There's so much to look forward to. But, you know, for today, primarily, I think there's one more ingredient in this whole mix, which is the Reliance Agm that takes place at 2 p.m. And we're going to track that very closely. Now, it's important because, of course, there's the big focus will be on the energy business. As we know, Reliance has announced a $10 billion spend on the new energy business over the next 3 years. But there could be some timelines in terms of, you know, project executions, etc., that would be announced. Also, they could announce the launch of 5G services. Remember, Reliance has spent over 88,000 crores to acquire almost 25 gigahertz of spectrum. So that's the other thing to watch. Now, everyone's keenly awaiting any timeline for the listing of Reliance Jio, Reliance Retail and the oil to chemical, the O2C unit. But it's unlikely. At least that's what market experts believe. But let's see. This is what you can watch out for today. Through the course of the week as well, you have the auto numbers that come out. So that's another big trigger to watch. And of course, it's a truncated week. But lots happening in the next 2.5 hours. Let's kickstart the show and tell you about some cues on the equity side. You have Eric Fishwick of CLSA who says that the tone of the Jackson Hole speech suggests no change to the 2022 rate forecast. He says this is either a 50 basis points or 75 basis points move at the September FOMC meeting. He says the market is discounting a little more than 50 basis points and then a reversion to the 25 basis points for a meeting in November and December. Eric adds, this would leave the Fed funds rate ceiling at either 3.5 or 3.75% at the end of the year, depending on the September increment. However, he does not expect any rate cuts in 2023.
Chetan Seth of Nomura says that Powell's hawkish speech will weigh on sentiment towards Asian stocks too, but some local buffers exist, like modest valuations bar for India and Thailand. He says investor positioning is light and sentiment is generally low, especially towards larger North Asian markets. He adds strong corporate balance sheets in China is accelerating stimulus to boost local economy. Chetan says local risks to watch include China's continued zero-COVID strategy, geopolitical tensions around China-Taiwan, and the extent of earnings downgrades, particularly in semiconductor, memory, tech hardware names, which will be dependent on the timing, duration, and depth of a likely U.S. recession.
Okay, let's also get you some money market views for today. You have Kunal Sudhani of Shinhan Bank who says Jerome Powell's hawkish speech has sent a bid on the US dollar and sending global equities lower and bond yields up. He says the dollar index can test 109.7 levels, the euro dollar may test 0.98 levels, and the pound can move to 1.165. He says Brent crude prices also seem to be a bit sticky, unable to sustain at lower levels. He adds, considering the above factors, USD INR may find a strong support at 79.60. He says a break of 80 levels will impact option sellers hitting their stops and let the dollar INR pair move towards 80.50.
Well, on bonds, we have Ajay Maglunia of JM Financial who says that taking cues from the Fed chief comments on likely rate action to fight inflation may have some mirrored impact. Story of India getting inclusion in global indices, bond indices that is, and likely flows as a impact did soften yields a bit. Focus on these two things in the last week has been driving the market and largely protected it from letting the yields rise. Any movement in oil and US yields shall have an influencing impact on yields here, but with increased investor appetite, market is protected from any major rise in yields. He expects the 10-year benchmark to trade in a narrow range of 7.2 to 7.27 today.
All right, we have a lot of stock-specific action as well to track today, and we'll get to that in just a bit in our Top 10 segment. We are looking at Jubilant Pharmova, GMR Infra, Rolex Rings, SRF, ICICI Lombard, Andhra Paper, SBI Cards. Those are stocks that are in focus on positive news flow. Then we also have Glenmark, Cipla, IRCTC. They're stocks that are likely to open up in the red. Actually, given the kind of start we're going to have, I guess most of these stocks will be opening up with a bit of a downtick.
Absolutely. You're going to be a bit cautious today, right? This is one of those days, perhaps, that you can just not do anything and you'll be fine. I mean, you don't need to trade every day. Today is going to be one of those really deep cuts in trade. At least that's what the SGX is indicating. But the world saw a hawkish US Fed chief at the Jackson Hole summit as Jerome Powell hinted at some pain in the US economy as the Fed continues its rate hike path. Let's listen into what he said exactly and what the market has made of it, and we'll come back.
Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The burdens of high inflation fall heaviest on those who are least able to bear them. Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain. In current circumstances, with inflation running far above 2% and the labor market extremely tight, estimates of longer-run neutral are not a place to pause or stop. Our decision at the September meeting will depend on the totality of the incoming data and the evolving outlook. At some point, as the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases. Restoring price stability will likely require maintaining a restrictive policy stance for some time. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply and to keep inflation expectations anchored. We will keep at it until we're confident the job is done.
All right, that's Jerome Powell on Friday. Well, that's essentially what set off the aggressive price action across markets around the world. Matt Orton is Chief Market Strategist at Carillion Tower Advisors, and Randall Krosner is Deputy Dean, University of Chicago Booth School of Business, and former Federal Reserve Governor. Gentlemen, great to have both of you here. Thank you very much for joining us. Mr. Krosner, if I can start with you, what was the interpretation for the market which was new from what Mr. Powell said? Was it the message that there is no pause coming anytime now, that rates will be higher for longer? Even if they pause, there is no cut. They'll stay high for longer. Is that the message? What was new?
So he had said that at the previous Fed meeting at the beginning of the month. He had said that he and his colleagues have been saying that over and over again since the Fed meeting, but the markets weren't believing it. And finally, when he gave a very short speech that was focused on one thing, which was we're going to be raising rates and then keeping them there until the job is done, as you heard him just say, the markets finally realized this guy's serious. They're going to keep rates up for probably most of 2023 rather than pivot sometime in early 23, which is what the markets had been expecting.
Okay. Randy Krosner is also joining in on the show. Randy, good morning and thanks for joining in. What's your own view on how to expect... Matt Orton is also joining in on the show. I beg your pardon. Matt, good morning. What is your own view on what the Fed would do in September? There is an expectation that there would be a 75 basis points rate hike as well. Are you expecting that? And do you think it was any different from what the Fed chairman's statement was earlier? Because it didn't look like there was too much of a change, but the market still got spooked anyway.
Hey, Sonia, always great to see you. And I don't think we know exactly what's going to happen in September. And the Fed didn't really give anything away at this meeting, nor should they, because they have said that they're going to remain data dependent. And we have non-farm payrolls coming out on Friday. We're going to get CPI kind of in the middle of September. I believe it's on September 13th. So both of these data points are going to be important to guiding what the Fed is going to do. I actually think the Fed's probably going to go with 50 basis points because, again, overshadowed with Jackson Hole last week was the fact that we're continuing to see some of the inflation readings come down. Headline PCE, core PCE, both came down lower. You're still seeing some resiliency with the broader economy. So that's all encouraging. So I don't think they're going to need to go 75 basis points. But to your other point, nothing that Powell said on Friday was really a surprise. We've been telling our clients that the notion of this dovish pivot, the Fed maybe starting to lower rates in 2023 was really, really misguided, especially given how strong the economy is. And so we've been advocating to our clients to maintain a more defensive position and still try and use some of these pullbacks opportunistically, because I still think in the intermediate term, this market is going to go higher.
Okay, all right. Got that, Matt. Mr. Krosner, coming back to you then, what are you factoring in for this September meeting? And also, some part of the stock market at least believed that maybe the Fed will go overboard in the near term and they'll be forced to pull back, in terms of the interest rates in 2023. Are you in that camp, or you believe, no, that rate cuts will not come about? Go ahead.
I really don't see that happening, although all of this is assuming no major geopolitical event. And of course, there are a lot of issues related to Mr. Putin. There are a lot of issues in Asia, a lot of issues in the Middle East. And so obviously there could be some sort of unexpected shock that comes in that could upend all of the forecasts. But putting that aside for the moment, the Fed is not about to turn around. Jay Powell talked about Paul Volcker and what Paul Volcker did. And so it wasn't by accident that he talked about the importance of making sure you get the job done. He talked about the mistake that was made in the late 1970s before Volcker came in to pull interest rates back down. As inflation came down just a little bit, then inflation exploded, and Volcker had to raise rates to double-digit levels. Remember, the last time that inflation was this high in the US, interest rates had to move to double-digit levels. I don't think they need to go there, but he was making it really clear that if we don't move aggressively now and then stay there to make sure that the job is done, as he said, make sure that rates stay high enough to ensure that the inflation rate comes down very close to their 2% goal, they could make the mistake of the 70s, have to raise rates really high and have a much, much more severe contraction or slowdown than we otherwise would have.
Right. Mr. Krasner, I mean, at the end of the day, this is also about credibility for the Fed, right? I mean, they need to be seen to be credible. They have to be credible, and then they have to be perceived to be credible. So that's true everywhere. There is quantitative tightening as well, the pace of which doubles starting September. So far, markets have been pretty sanguine about it, okay? So far, there's been no great impact in markets. There's a bit of lack of clarity in terms of how the impact is going to go through into equity markets and other risk markets. Does that also come into sharp focus now with what we heard?
So I think the Fed likes to focus monetary policy on interest rates and have the balance sheet be either increasing or decreasing more in the background. And so you're exactly right. The pace of the reduction of the balance sheet size will step up as the fall comes. They're hoping that that's not going to cause any disruption to market liquidity, and so that can just going to go on in the background. But their main focus is going to be interest rates.
Matt, how does one approach global equities now? Because at least for a market like India, despite all the challenges, this market has climbed every wall of worry. We're not even 5-10% away from the all-time highs. Do you reckon that could be the case through the course of the year, that despite all the rate hikes, the market will continue to inch up higher, especially emerging markets like India?
I think, Sonia, is selectivity in what moves higher is going to be the most important thing. And last time we spoke, I was speaking about my optimism around India and Latin America, as well as U.S. equities in particular. And while I still favor U.S. equities just because of the diversity you get and the ability to lean into dividend growth and more growth at a reasonable price, I still believe that there's a lot of opportunities in Indian equities and Latin America, especially in industrials and financials. Those parts of the market have held up very, very well. Certainly on a pullback, I might be looking to add a little bit more exposure to both of those areas because they're a little bit insulated from what's happening in the rest of the world. Demand in emerging markets is remaining strong, and the emerging market complex overall is trading at the cheapest levels relative to the S&P 500 as it has in over 20 plus years. So, certainly emerging markets are poised for a bounce, but you need to be really, really selective in what you own. And even within India and Latin America, you need to be selective of what you're going to own as well. I think that's front and center, especially given the volatility that we're seeing right now. But I would certainly use this volatility opportunistically.
Okay, all right. Matt, just a quick clarification from the emerging market basket. Where does India rank? We're relatively more expensive. Point number one, if you could give us a sense on that. And also forget about all-time highs. The lows that we made in June, do you believe that that will hold out for global equity markets?
So I think for U.S. equities and for some emerging markets, I do think that the lows we saw in June are probably going to hold. It's irresponsible to deal in certainty, so I'm not going to say with 100% conviction that we have absolutely seen the lows. but I feel more and more confident that we have. In the US, you're seeing the advanced decline line hit new all-time highs. If anything, I'd say we might have a stealth bull market that's happening beneath the surface in the US. I would say in the Indian equity side too, it still screens favorably relative to other emerging markets. The price action relative to the EM complex and relative to even other outperforming countries looks very, very good. And while valuations might be relatively more expensive, that's not necessarily a bad thing given the growth characteristics that are embedded and the fact that the consumer is still doing well, the economy continues to reopen, and you're seeing earnings resiliency as well. So I like it. I'd say because of the valuation aspect, I'd put India #2 on my list after Latin American equities, because I still think there's room to run. And you get favorable tailwinds with respect to commodities, given the ongoing crisis in Russia and Ukraine.
Matt, absolutely sort of with you on growth and growth characteristics of the economy here, etc. The only pushback one gets is valuations. I mean, it's always been an expensive market, relatively speaking, India, that is. And right now, I mean, it's not very expensive, but it's not cheap either. Some 20 times 1 year forward earnings, right? So when you rank India at #2 basis valuations, just wanted to clarify that. Are you saying it's cheap from a historical perspective?
I'm saying it's relatively more expensive. I like the growth characteristics, but relative to Latin America, I think it's that valuation aspect that moves it into the #2 slot.
Fair enough. We'll leave it there. Gentlemen, thank you very much for joining us. Matt, great to have you with us here as always on CNBC. Mr. Krosner, it's a pleasure, and hope to have you back again.
Shade of red. It's courtesy the global markets. Let's see which way it goes. For our own markets, of course, we had not such a bad week, but we have put to an end the 5-week winning streak. So last week was a week in the red, and this morning is not looking pretty at all. But our research team is joining in to help us, prep for the day. Our list of top 10 stocks. So let's begin with Ekta. She's tracking some pharmaceutical names this morning. Ekta, what are you looking at?
Hi, thanks for that. Well, I'll start with a stock which could probably be in the green today, Jubilant Pharmova, because their radiopharma manufacturing facility in Montreal has got the establishment inspection report with a voluntary action indicated status from the US FDA, which means that they've been given the green signal for that particular facility, which was inspected from the 6th to the 10th of June. It is basically under a wholly owned subsidiary of the company. But what I would be watching out for in terms of one of the most important stocks today would be Cipla, because the US FDA has issued 6 observations to the company's Goa plant, which was inspected by the US FDA. We had reported on that, and they have said that there was some reference to the observations which were made during the September 2019 inspection. Remember, the September 2019 inspection for Cipla eventually turned into a warning letter for Goa. The plant was inspected from 16 to 26th October of August of 2022. They said there are no data integrity observations, but the street will possibly factor in a delay of one of their key cancer drugs, which was expected to be filed from this particular facility and is expected to be in FY23. Lastly, Glenmark, also not good news there. Their Goa plant is categorized as official action indicated. It was inspected earlier in May of 2022, and that means that the US FDA could withhold any kind of approvals from that particular facility, and the possibility of it escalating unless the observations are solved properly by Glenmark is also high. So I expect Cipla, Glenmark to be in the red, Jubilant Pharmova to probably be in the green.
Okay, all right, Ekta, noted that. Well, let's hop across to Mangla. Mangla, you're tracking Rolex rings that over and goes out now since the PE is completely out, and IRCTC as well, expecting to pull back.
That's correct. So we start with Rolex rings. There was a large trade on Friday, 12.5% equity, and now we know that it is Riverdale PE LLC, which has done a clean-out trade out there. Importantly, on Friday itself, the stock rallied about 6% from lows, and the entire 12.5% supply was absorbed. And how we have some strong, mutual fund names as well. We have ABSL, Canada Robeco, DSP-MF, ICICI Pru. A lot of them have been key buyers out there, so expect that stock to continue to do well in today's trading session, notwithstanding, of course, the market environment that we're in. So dips expected to be bought on that one. IRCTC, however, has seen a good month, almost 13% higher this month. But remember, the reason why the stock rallied was on reports of data monetization floated by the company. But then again, the company has gone ahead and withdrawn that e-tender of appointment of a consultant for data monetization. And the key reason for that is that we do not have a personal data protection bill coming in from the government. So once there is clarity on data protection, only then can the company look at monetizing the data of almost 7 crore users that it has.
Okay, thanks a lot for that. Well, let's go across to Vahishta now. She's tracking GMR Infra this morning. Vahishta, why is that?
Hi Sonia, thanks for that. Yes, GMR Infra has scheduled a board meeting on the 2nd of September, and this is for raising funds to the tune of approximately 6,000 crores, which could be in one or more tranches through the issue of securities. Now let's look at the debt levels on a consolidated basis that the company has, which is at approximately 24,000 crores. This is as on 30th of June 2022, and the money that they are planning to raise now is expected to be utilized for the ongoing capex, which is for the Goa airport construction and the expansion of the Delhi and Hyderabad airport work.
Okay, all right, got that. Sonia, Sonal, in fact, is joining in to tell us about some more stocks in the news. Sonal?
Good morning, Nigel. Well, let me start with SRF. The company has gone ahead, commissioned their second BOPP film line and metallizer project. That is on 25th of August that they announced that. The total cost is 446 crore rupees and the approved cost was 424 crore rupees. ICICI Lombard is in focus as well because they've launched a slew of products, 14 products in total across health, motor and corporate segments. Andhra Paper in focus because they've announced a capex of 400 crore rupees, out of which 113 crore rupees will be on equipment reliability and sustainability of the current levels of production, basically maintenance capex, and 287 crore rupees will be towards upgradation of their pulp mill capacity. And lastly, also watching out for SBI Cards because the monthly spending numbers have come out for the month of July. For SBI Cards in particular, it's a 2.8% increase on a month-on-month basis. This compares with 6.5% month-on-month increase that the industry saw. On a YY basis, it has come in at 35%.
Okay, thanks a lot for that. So the monthly spending is up 35% versus 55% for the industry. So SBI Cards actually underperforming the industry. That's interesting. Let's see which way the street takes it. Here's a quick recap of our top stocks. Stocks with positive news flow: Jubilant Pharmova, GMR Infra, Rolex Rings, SRF, ICICI Lombard, Andhra Paper and SBI Cards. While stocks with negative news flow, there's Glenmark Pharma, Cipla and IRCTC.
Welcome back. There's 20 minutes to go for the pre-open session to kick off. Prakash Devan is joining us now. The SGX still indicating a 2% lower start. That's about 371 points. Prakash, good to have you with us here on the program as always. Thanks very much. So we'll start sharply lower. The question is, will dip buyers come, or do you think it's going to stay like this for a while? After a gap down, maybe sideways, a little bit lower, before things start to look up again. What's your sense?
Good morning, Prashant. So, it's pretty tough to anticipate the reaction of the market because this was something which is more like a wake-up call. It's a double-edged sword. I mean, on one side, that this is something which is not precipitated, out of the blue. It has been in the making for a while. And the second thing is that it also makes you believe that it's coming at a time where Europe is crumbling big time and there's a cold, dreary winter ahead of us. And if the US were to kind of get into this kind of a tizzy, what happens to our market is that it's been driven by this momentum in the last couple of months thanks to FI buying. And that is something which could have a negative impact, and it would trickle down into a probably negative flow or probably almost at a standstill. But what it does is, on the other side, that while India valuations have been expensive on an indices basis, people who are looking at selecting stocks or picking up stocks for their portfolio will probably find businesses which are slightly insulated or relatively insulated from what's happening to the US economy and the reaction of the Fed thereon. So I think it's going to be a stock pickers market. It'll become a very bottom-up market now. I don't think there's anything trending in terms of the macro moves that you could benefit out of. And that's exactly where, the India focus will become much more sharper. And then it'll probably be driven by domestic flows and retail participation. So whether that happens, the buying on dips happens today, I don't know. I don't think so it would happen in such a hurry because the stock pickers always have more patience as compared to trend, traders. So my sense is that today you'll probably see a little bit of sell-off and driven by a lot of algos, a lot of levels that people watch out for critically. And once that happens and the dust settles is probably when you'll probably see stock-specific action, which may not translate into indices again, as I said earlier, but then it will probably be back to business in a couple of days.
Okay, I want your thoughts on the auto ancillary space because it's leading up to a discussion that we're having with Lumax Autotech, and I'm sure you track that as well. But any auto ancillary you pick, Prakash, Asahi India, Precol, Rajratan Wire, Mahindra, CIE, Shanti Gears, all sitting at fresh 52-week highs. What's happening here and what's your pick of the pack?
So, Sonia, good morning. It's an interesting space, and we've kind of, made a comeback of sorts thanks to the fact that most of our auto ancillary plays, and including Lumax, when you hear them out, you'll realize, it's become quasi-global now. None of these companies are depending anymore on domestic sales or domestic growth trajectories. They have started eating into market share, which earlier probably was catered to by some of the Latin American players or some of the European players as well. But my worry on auto ancillaries is that anybody who's exposed to the European market is going to go through a little bit of a shift in terms of their numbers. I don't think Europe is going to be in a position to produce and absorb and place orders for a lot of the auto ancillaries thereon. And interestingly, the OEM market in India, if the chip shortage is kind of resolved completely, is likely to bounce back much more sharper. So now the focus will have to be on auto ancillaries that are more domestic. So, simple thing. And I remember Nigel covering some of these small names, recently introduced names like SGS and all, which are into very different spaces, which are into very niche kind of spaces. And that has started doing well. So informatics, telematics, cosmetics, aesthetics, those are things that are kind of looking up quite positively. I would wait for the European market to kind of give some sort of an indication of how bad things are going to be before buying into an auto ans. But interestingly, companies that are into tires and supplying tires and raw material for tires are the ones that could probably be interesting. So Rajratan, of course, features there. You could have a chemical play from the side of Nosil. So there are these interesting plays that you could look at. But I'm sure we'll get to know much more insights into the sector once we hear the management ahead of us. Yeah.
Absolutely, and like something like a Rajratan Wires, right? 30% in just 1 month. It's really been terrific, the moves in this space. But we have a management joining us. So auto ancillaries have seen very strong demand surge because of new launches and higher demand from OEMs. Companies like Lumax Autotech have hit fresh 52-week highs. In fact, the stock is up 80% just this year. Now, Lumax Autotech manufactures gear shifters, emission systems, 2- and 3-wheeler chassis, and the Lumax Group is the market leader in automotive lighting and gear shifters. Anmol Jain, who's the managing director at Lumax Autotech, joins us now to talk about that. Anmol, good morning and thanks for joining us. I want to first start about the order book, because in your Q1 presentation, you mentioned that you have an order book of 600 crores. What is the visibility like in terms of execution? How much of that will flow through in this fiscal itself? And anything in the electric vehicle space that you're looking at?
Good morning, Sonia. Thank you for having me. First and foremost, the order book, you're absolutely right. We have 600 crores of order book, out of which actually we have 450 crores, or almost 75% of that, which is new orders. I would say about close to 30% to 40% would come in this fiscal itself, and the subsequent numbers would flow in FY24 and peak out in FY25. I'm happy to share that almost 50% of this order book is also in the passenger car space, which is a part of our long-term strategy to strengthen that segment, because we've traditionally been more of a two-wheeler player. But as things are looking forward, I think we will expand our passenger car footprint. In terms of electric vehicle, just to answer to that question, most of our products are actually EV agnostic. The gear shift levers, the telematics, the mechatronics, all of them, we are already in discussions. We are currently supplying the gear shifters to EV makers as well. But we're also in discussions with some of our other products for the future models. But in terms of the current product portfolio, perhaps I would say that maybe about 5% of our revenues is what I'm looking at in the next 2 to 3 years from EV space. But the company is in the process of rolling out an EV critical plan for EV critical components, and we expect to make some announcements later during this year.
Hi, morning, Anmol. Thanks so much for joining in. Nigel on this side. Anmol, for the last few quarters, you've been clocking around 420, 430 crores odd in terms of revenues. So for the year, given that you have been going at this run rate, what should we be looking at in terms of revenues? Should be in the vicinity of around 1,700 crores. And also margins have improved. You're clocking closer around 11% out here. But now input costs have cooled down. What's the broad margin range we should be working with for FY23? Go ahead.
Morning, Nigel. Sir, absolutely right. We've been clocking about 420, give or take. The last year we closed at about 1,500 crores. We've always traditionally said that this company has surpassed the industry growth rates. And I think I gave this outlook that almost 20 to 30% is the growth we're expecting in this fiscal year on our top line. So give or take anywhere between 17 to 1,800 crores is what I would be envisaging. Obviously, if the current momentum, which is a very strong recovery, which continues, and I don't see any reason why it should not. Like you rightly said, the raw material prices have eased off. I think the hyperinflation, which we were looking at a few months ago, has definitely cooled down. So I think the supply chain volatility does continue, but I do not anticipate any showstoppers in terms of raw material or input costs. And moreover, Lumax has always been able to recover most of the raw material escalations from our OEMs. And if you look at our track record over the last 4 to 5 years, I think we've been consistently able to maintain or improve our contribution margins. So in terms of margin outlook, you're right, we've come close to 11% plus EBITDA levels. I think my outlook has always been to try and garner a 13% EBITDA, as I say, a teen EBITDA percentage. And I think we were moving forward in that right direction.
Anmol, just two questions. You said most products are EV agnostic, which means that you can sell what you produce to EV straight up. You don't need any changes to that, right? And second, you said an announcement of some sort close by. What sort in the EV arena?
Good morning, Prashant. So when I say EV agnostic, what I essentially mean is that with the EV vehicles, our products do not get extinct. Of course, there is a technology curve. There is a technology transformation. I cannot just say the same product would fit on an ICE engine as well as an EV vehicle. So there will be a technology curve, but most of them do have an opportunity to make it to the EV space as well. In terms of EV critical, those are, let's say the motor controllers, the battery management system, components which do not go onto the ICE engine vehicles, only on the EV vehicles. The company is still evaluating. We want to be in that space for sure, but we also don't want to make a mistake of just getting into a space which will become very, very crowded. So we're still evaluating our options, and I would expect sometime later in FY23, we would probably roll out our plans and announce them to the market.
Okay, now we know why the stock has gone up 70% in 3 months, right? These are some really aggressive plans that you have, Anmol. 20 to 30% revenue growth in a challenging market like this. And I call it challenging because a large part of your, revenues comes from the two-wheeler space, names like Bazaar, HMSI, etc. And these players have seen a slowdown, right? Especially in the mass market segment. Would that be a worry for you? And you have an enabling resolution to raise 400 crores as well. Do you plan to do that anytime soon?
Sonia, absolutely right. I think, we've been traditionally a two-wheeler company, but I'm happy that two-wheeler is now only 40% of the pie. We have almost 25 to 30%, which is the passenger vehicles, as well as aftermarket, which is very strong for us, which is almost 20%. We're very bullish on the aftermarket, and that's something which we usually garner a much higher margin on. So I think going forward, as I mentioned, the order book itself, almost 50% of our order book is for the passenger car space. So our dependability on two-wheeler is definitely reducing. Not to say that we are losing any market share or wallet share in that space. We're very strong with the Bajaj and HMSI for the products we supply. And in fact, we have only increased our wallet share in the last fiscal as well. The other question you talked about was on the EV space, right?
No, the 400 crores enabling resolution that you have, will you be looking to raise funds anytime soon?
So it's an enabling resolution. We do not have any concrete plans yet to raise those funds in FY23. But I always say, we're always looking out for opportunities, inorganic opportunities to, raise capital and see how can we fast track this growth rate. I think 20 to 30% growth is something which we will do organically. But if there are any other opportunities, we'll definitely evaluate them. So it's an enabling resolution, nothing more.
All right, Anmol, very quickly before we wrap up, you're doing 400 crores per quarter. With the current investments that you've made, what is the peak revenue that Lumax Auto can achieve, since you're talking about big growth from here on? Peak levels, potential.
So Nigel, very quickly, I think our gross block to sales ratio has traditionally been around 2.2 to 2.5. It's very difficult for me to give you a number because, based on the diversity of our product lines, diversity of our customer portfolio, as well as capacities, it's very difficult to determine what are the capacity utilizations and what is the kind of revenue each of the product line can do. It's very, very diverse. But I would say that without any significant capex, just some brownfield or capacity enhancements, we should be able to easily look at, close to give or take 1,800 crores, which is our this year number. But aftermarket, as I said, does not really need any capex, significant capex, but is always a very strong growth driver for the company.
Okay, well, all the best. You've done exceptionally well so far and hope this turns out to be a strong year for you. Prakash Diwan has been listening in. Prakash, are you convinced with this one? In any case, it's rallied a whole lot, but do you think there's more to go?
I think they've reached, they seem to be reaching scale, which is very critical in the ancillary business. And if you are supplying critical components or components that only you can kind of timely deliver, that's the only time OEMs will let you make margins, which is happening in the case of Lumax. So yes, I think very clearly the market is excited about the visibility of earnings going forward, as Anmol shared, and that's what keeps investments secure. So I think from that perspective it is positive. But from a valuation perspective, you could differ in terms of whether you want to look at buying at lower levels, and you will probably get lower levels, right? So that's my call. I also put some of the other companies like Suprajit into the same bracket, but because Lumax is more domestically focused, they probably are more insulated in that sense. So yes, very, very positive. Hopefully all this expansion that he's talking about will translate into top line and bottom line growth, and the operating leverage will start kicking in. So quite positive, buy it at lower levels for sure.
Welcome back. Brace yourself. The SGX is suggesting a big downtick to kickstart trade, so it's going to be a rather volatile trading session. Good time to get in. Mitesh Thakkar as well as Sudarshan Sukhani. Good morning, gentlemen. Thanks so much for joining in. Well, you have the SGX rate on the screen. Sudarshan, how are you approaching trade today?
Good morning. See, the markets are now coming down because of a US news event and the US reaction to that news event in the US markets. We are going to follow them. So there's nothing much to do. You can't go short. As Sonia was saying, it's going to be a hard day, tough day for the bulls. Agreed. Actually, it's going to be a tough day for the bears also, for the simple reason that you cannot and you should not go short after a 300-point gap down. So today's trade is simply a wait and watch day. You don't, it's difficult to say this is a dip, go and buy it. There is a news event behind us which may not suggest it's a dip. We could be going much lower. So buying is not suggested. Selling is not suggested because we are opening with such a large gap down. Any relief rally can come during the day. It may not be tradable, but it can cut a short seller's pockets. So stay away from the trade today. But it does appear that the rally that we saw is probably coming to an end. It's too early to say that, but the first signs are now visible.
Okay, all right. So Sudarshan, appears for today, you're saying maybe stand on the sidelines may not be such a bad idea, but we'll come back to you for individual stock calls. Mitesh, what about you? Are you feeling ambitious today, or do you believe that, enjoy the win that India had last night? You have a truncated week as well, so better things to look forward to. Don't be a compulsive trader today.
Morning, Nigel. I think that may not be a bad idea. I think because of the pure reason that while, we are opening with a gap down, we are still some distance away from the critical medium-term support areas. I think Prashant or Anuj, I think Prashant was highlighting this in the morning, that around the 200 average, then the 16,950 gap. I think that is a very strong support area. So when you have a decline of this kind of magnitude, starting with a big gap down, typically I think it will hit those important support levels. So today may not be the best idea, or at least today morning may not be the best idea to buy into it. But closer to about 17,000, 17,020 mark with a stop below 69.50, I would want to enter a long. And as I said, I think, I'm not sure whether that will happen today or that will happen tomorrow. But the idea is that this level, if it holds, will possibly, keep the uptrend intact. But if we start breaking below that, then I think, as Sudarshan said, I'd be worried about the medium-term trend also.
Okay. Sudarshan, if it's going to be a tough day both for the bulls and the bears, what do you do with individual stocks? I mean, every day you don't need to trade, right? So perhaps hands-off is the best strategy. But if someone still wants to look at individual names, what's the list?
Yeah, that's a fair point. If someone still wants to look at individual stocks, and there's no harm, because stocks will do their own things quite often. There is a longer list of intraday short selling. Starting with GSPL, the GSPL has already been in some kind of a downtrend. It's an intraday short with a stop above 245. Intellect has been a short selling idea. It's come in my list earlier also. The stock is in a similar downtrend as GSPL, intraday short with a stop above 598. Marico is suggesting that the rallies that it saw was now facing distribution and selling pressure. So while it's not in a downtrend, the chances are it could enter a downtrend, and we are selling in anticipation with a stop above 521. Just to round it off and make it a little more cheerful, Power Grid was a very handsome player on Friday. I think that should continue. Of course, it won't cross the 3-month highs today. It's very unlikely. But a dip in Power Grid is actually a buying opportunity with a stop under 223.
Okay. We'll do one thing. Okay, Mitesh, quickly, what are your ideas for today?
So more on sell side, Coforge is a sell with a stop at 3,700, targets of 3,550. Lupin is a sell with a stop at 662, targets of 626. SBI Cards, that's a sell. Keep a stop at 921, look for targets of 866. And a solitary long is Jambal Fertilizers, which on a decline, say around 341, buy with a stop at 334 for targets of 358.
All right, a quick break on that note. On the other side of the break, the pre-opening rates. Also, we will have Samir Arora of Helios Capital to discuss the way ahead for the market. Stay with us.